It was recently reported that Warner Brothers Discovery rejected an acquisition bid from Paramount. Since the news leaked, it's also come out that there are multiple media companies interested in buying Warner Brothers Discovery or some of its assets. To help make sense of all this consolidation, we brought in Ocean Media VP Media Investment Stephanie Stanczak and Associate Director of Media Investment Michelle Sullivan. So I
Hi,
guess my first
guys. Oops, sorry.
no, that's all good. Uh, my first question would be we've already seen consolidation from Disney, Hulu, and Amazon MGM, and there are rumors around Peacock's future. It's now reported that Warner Brothers is fielding multiple offers for the entirety or a spin-off of its assets. Stephanie, are we approaching the final phase of streaming consolidation where only a few mega platforms remain?
That is a great question, Kenny. I actually think we are quite far away from this final phase that you're suggesting. I think consolidation and mergers are going to continue to happen in this industry, and it's part of the evolution of our industry. And so I think the market is still maturing, and so I think we're going to continue to see that in the coming years. It might look a little bit different as we go, but it will continue. I think what we might see a lot more of is bundling. We saw that this year Disney's bundled Hulu and ESPN under one app, and I think we're going to see a lot more of that before we see these, mega platforms coming through. What do you think, Michelle?
I agree. I agree with all those points. I definitely think that the marketplace is going to continue to remain dynamic. I think with Warner Brothers, we're really at the early stages of them kind of shopping the market. And, Paramount's already made 3 bids, and they're really out there now trying to drive up the stock price to see if they can get Paramount to come up to something that, they could find valuable for the whole company. And so it really depends on if they end up selling the company as a whole or separating it and selling it in parts. But I definitely don't think that we're at the final stages of streaming consolidation. The marketplace, will always continue to evolve as these companies try to drive shareholder value. And I definitely think that the major players will continue to stand between YouTube, Netflix, and Amazon, and everybody else will really be out there kind of evolving and changing and making shifts to compete for the next highest share.
So, hypothetical, let's say Warner Brothers Discovery is acquired. Who would be next? Could we see NBC Universal? Could we see Sony, Apple, Netflix? I guess who's next?
I definitely think it really depends on who ends up acquiring Warner Brothers Discovery and what the nature of that deal is, whether it's sold as a whole or in parts. The outcome will really likely set the stage for the next phase of what happens in the marketplace. Is it more consolidation? Is it more companies divesting legacy assets? And then what does that mean? I do think that bigger companies like Apple and Netflix have really continued to stand the ground that they are not interested in buying the legacy assets. So it really will depend on how it all kind of unfolds. But there's definitely more to come, and it will always be making moves to try to drive, profitability for these companies.
So Warner Brothers has had a bumpy history with past mergers. For example, the merger with AT&T was plagued with strategic overreach and massive debt, while Discovery had its own financial turmoil. What lessons should Warner and the company that inevitably buys them take from Warner's previous merger history to avoid repeating past mistakes?
I think one of the biggest takeaways from that merger is that just combining 2 legacy content libraries doesn't automatically solve deeper business challenges. That really came with a lot of debt, and they didn't have the resources, or they don't have the resources to compete with the likes of Netflix, who's spending, $18 billion a year on content. You've got YouTube out there with just unlimited user-generated content. If you don't have the resources to compete, to continue to produce content, and you are not acquiring sports rights, and you lost the NBA, I think that really put them at a disadvantage. Overall, really, they were plagued by their debt. So again, just making it so that not content isn't going to always be the answer, but you really need the financial setup to set you off on a good path.
Well, and that debt's going to continue to plague them, I think, because it's quite a lot, right? I also want to add, I think having a clear and focused vision before they're combining empires is always a recipe for success. And this new owner really needs to protect brand equity with the combined company. I think Warner Brothers could definitely learn from a recent mistake that they've made, in my opinion, moving HBO Max to Max and then back to HBO Max. It created confusion with the audience instead of expanding them. I also felt it devalued the HBO IP, which is so iconic. It's the reason why I bought a whole year in advance of HBO Max without commercials, since I couldn't fathom a world where I saw commercials in HBO content. So I think that that's really going to be important for them to keep in mind with the merged company.
So I want to switch gears here to how a brand navigates these big changes. From an advertiser's perspective, do these mergers simplify or complicate media buying?
I think it can be a bit of both, right? Mergers can simplify things in some ways and complicate them in others. Long term, I definitely think it simplifies things and brings more inventory and more pieces together, unifies platforms to create stronger reach and be able to create campaigns at a greater scale and use data and targeting at a greater scale. Short term, though, there are always like some bumps in the roads as the companies merge and they need to kind of combine their ad tech and combine their capabilities and ad sales teams. So I definitely think longer term, it's usually a positive, but short term, it can be a little bit bumpy or rocky.
With more inventory under one roof, do brands gain access to greater reach and cross-platform targets, or does it create new barriers or entry for smaller advertisers?
Creates greater reach, more scale, again, more cross-platform targeting, more ability to use first-party data across a larger, inventory pool. For smaller advertisers, though, it can have a barrier to entry because it also can come with higher minimums, and it can be harder for smaller brands to reach those to come to market and participate. Which is where having, a strong agency partner can really be a benefit to smaller brands to help them sort of navigate those hurdles.
And I'll just add, I agree with everything you said, Michelle, but it obviously depends on the merged assets. So there could be some benefits based on who's merging. One would hope and think that overall it should create greater reach and targeting capabilities and, more opportunities for advertisers.
Stephanie, how might advertisers benefit or suffer if sports rights were consolidated or dispersed under fewer or more corporate umbrellas?
Well, right now, I think that we're dealing more with fragmentation than consolidation. So you guys may know this. I'm a big hockey fan, and I joke all the time that I have to go to my Instagram page. I follow the NHL. I got to see where the game is airing, and I know many fans have to do the same to figure out what platform it's on that night. So this becomes a big challenge for advertisers because they have to now do deals with multiple partners instead of just one that might have all the NBA, for example. So, and that also means that they need to work harder to reach the audience and chase the fan on the different platforms. So I think it creates a different challenges for advertisers.
Michelle, can you talk about how a merger impacts measurement? How do we as an agency tackle measurement when two streaming giants combine into one platform, like when Disney Plus and Hulu came together?
I think when streaming partners or platforms merge, it creates a really big opportunity for advertisers. It combines inventory pools to allow us to target audiences at greater scale and derive more cross-platform insights. There's better attribution and a better way to, use first-party data more effectively and reach audiences more effectively. Overall, it's typically a win for the industry to have more inventory and data housed in one place that allows it to be used more strategically.
Thank you, Stephanie and Michelle, and thank you all for watching. To learn more about advertising trends, brand strategy, and media investment, visit oceanmediainc.com for all the latest news and insights.